67 million ounces. That is the number that will define the financial future of every investor watching this video right now. 67 million ounces of silver that the world needs, but simply does not have. For the sixth consecutive year, the global silver market is heading into a structural deficit, and the With John AG forensic research team has uncovered evidence buried deep in the institutional data that proves this deficit is not shrinking. It is accelerating toward a breaking point that will send silver prices to levels that most people alive today have never witnessed. While Wall Street and the mainstream financial media keep you focused on artificial intelligence stocks and cryptocurrency speculation, the physical silver market is screaming a warning that only those with access to the forensic data can hear. The supply is vanishing. The demand is relentless. And the price you see on your screen today at $81 an ounce will look like a relic of a bygone era when we look back from the other side of this crisis. Before we dissect the forensic evidence that proves why silver is setting up for the most explosive move of the 21st century, you need to subscribe to the With John AG channel right now. What you are about to hear is the kind of institutional grade analysis that hedge funds pay millions of dollars to access. We are giving it to you for free because the With John AG mission is to ensure that everyday investors are not left behind when the greatest wealth transfer in history unfolds. Hit that subscribe button and the notification bell because the data I am about to reveal will fundamentally change the way you think about money, wealth, and the future of the global financial system. Let us begin with the number that the Silver Institute just released this week, because this single data point contains more information about the future of your financial well-being than every earnings report from every company in the S&P 500 combined. The Silver Institute, working with consultancy Metals Focus, has confirmed that the global silver market is heading for its sixth consecutive year of structural deficit in 2026. The current estimate is a deficit of 67 million troy ounces. Now I want you to think about what that means in concrete terms. For 6 straight years, the world has consumed more silver than it has produced. For 6 straight years, the above-ground stockpiles have been drawn down to fill the gap. For 6 straight years, the market has been eating into the reserves that took decades to accumulate. And for 6 straight years, the price has been telling you that this situation is unsustainable. Silver rose 147% in 2025 alone. It hit a record high of $121.60 on January 29th of this year, driven by frenzied retail buying. And the With John AG forensic analysis shows that this was not the top, it was the dress rehearsal. The supply side of the silver equation is where the With John AG forensic team has identified the structural fracture that cannot be repaired with monetary policy or government intervention. Total global silver supply is forecast to increase by just 1.5% in 2026 to a decade high of 1.05 billion ounces. Now the mainstream media will report that as good news. Supply is increasing, they will say. Problem solved, they will claim. But the With John AG forensic analysis reveals a completely different reality when you dig beneath the headline number. Mine production is forecast to increase by only 1% to 820 million ounces. 1%. In a world where industrial demand alone is consuming 650 million ounces per year. In a world where physical investment demand is surging 20%. In a world where the deficit has persisted for 6 consecutive years. 1% supply growth is not a solution. It is a rounding error on a catastrophe. The mining industry cannot produce silver fast enough, and here is why this problem is structural and permanent. Silver is primarily produced as a byproduct of copper, lead, and zinc mining. Only about 30% of silver production comes from primary silver mines. This means that silver supply is largely dependent on the economics of base metals mining, not on the silver price itself. Even when silver prices double or triple, the supply response is muted because the mining companies are making their investment decisions based on copper and zinc economics, not silver. The With John AG forensic research into mining capex budgets shows that there are virtually no major new primary silver mines scheduled to come online in the next 5 years. The existing mines are depleting at an accelerating rate as the highest grade ore bodies are exhausted. The average ore grade of silver mines globally has declined by over 40% in the last 20 years. This means miners have to move twice as much rock to produce the same amount of silver. The cost curve is steepening, the geology is deteriorating, and the supply response that the market desperately needs is simply not coming. Recycling is expected to rise by 7% in 2026, exceeding 200 million ounces for the first time since 2012. The With-John AG analysis acknowledges this increase but puts it in context. 200 million ounces of recycled silver sounds impressive until you realize that the total demand is over 1 billion ounces. Recycling is filling 20% of demand at best. And the recycling increase is itself driven by higher prices, which means the marginal cost of recycling is rising. You cannot recycle your way out of a structural deficit when the deficit is 67 million ounces and growing. The With-John AG forensic model of the silver supply chain shows that at current consumption rates, the identifiable above-ground inventories of silver could be critically depleted within the next 3 to 5 years. When a physical commodity market reaches that point, the price does not go up gradually. It goes up violently as buyers scramble to secure the remaining supply. Now let us turn to the demand side, because this is where the With-John AG forensic team has uncovered the most compelling evidence for a silver price explosion. The Silver Institute data shows that industrial silver fabrication is forecast to decline by 2% in 2026 to a 4-year low of 650 million ounces. The mainstream analysis will tell you this is bearish for silver. Less industrial demand means less total demand, which means lower prices. But the With-John AG forensic investigation reveals that this decline is actually one of the most bullish signals imaginable when you understand what is causing it. The decline in industrial demand is being led by thrifting and substitution in the photovoltaic sector. Solar panel manufacturers are finding ways to use less silver per panel, and in some cases substituting other materials. This sounds bearish on the surface, but here is the forensic truth that changes everything. The reason they are thrifting and substituting is because silver has become so expensive and so scarce that they can no longer afford to use it at the same rate. When an industry is forced to redesign its products to use less of a material, that is not a sign of weak demand. That is a sign of a supply crisis so severe that the market cannot function at current price levels. The With-John AG analysis of the solar industry shows that despite the thrifting, total solar panel installations continue to grow at 30% per year globally. Even with less silver per panel, the absolute number of panels being installed is growing so fast that total solar silver demand is only declining modestly. And here is the critical insight. There is a floor to how much silver can be reduced per panel. Below a certain loading, the panel efficiency drops to the point where it is no longer economically viable. The solar industry is approaching that floor, which means the thrifting trend will exhaust itself within the next 12 to 18 months. When it does, the industrial demand for silver will reignite at the same time that investment demand is surging. This convergence is the ignition point for the next leg of the silver supercycle. Physical investment demand is the force that the With-John AG forensic team believes will be the primary driver of silver prices in 2026 and beyond. The Silver Institute forecasts that physical investment in silver will rise by 20% to a 3-year high of 227 million ounces. Western demand in this category is recovering after 3 consecutive years of decline. This is a seismic shift in investor behavior that the market has not yet fully priced in. For 3 years, Western investors were selling their silver, or at least not adding to their positions. They were chasing technology stocks and cryptocurrency and meme stocks. They were told that precious metals were relics of a bygone era, and now they are coming back. The With-John AG analysis of investor flow data shows that this recovery in Western physical investment demand is still in its earliest stages. The 20% increase projected for 2026 is the first wave. Historical precedent shows that once Western investors rediscover precious metals, the buying can persist for 5 to 7 years, and the annual increases can exceed 50% as the momentum builds. We are at the beginning of a multi-year investment demand cycle that will collide with a supply deficit that is already in its 6th year. The With-John AG forensic model has never identified a setup with more asymmetric upside potential. Now I need to talk about China, because what is happening in the Chinese metals markets right now is the wild card that could accelerate the silver timeline beyond anything the institutional forecasters are projecting. The With-John AG forensic team has been analyzing the extraordinary developments on the Shanghai Futures Exchange and the Guangzhou Futures Exchange, and what we are seeing is nothing short of a paradigm shift in how global metals prices are determined. Open interest for base metals contracts on the SHFE and lithium contracts on the Guangzhou Exchange have surged to record levels from late 2025 through January 2026. Trading volumes for several metal futures on the SHFE have hit all-time highs, And the primary driver of this unprecedented trading wave is Chinese retail investors, who are deploying substantial capital into bets on continued rallies for base metals. ING commodities strategist Ewa Manthe stated it unequivocally. China has become the center of short-term price formation in metals. The With John AG forensic analysis of this shift cannot overstate its significance for the silver market. China has transformed from the world's largest physical consumer of metals into a crucial financial trading and short-term pricing hub. The sheer scale of domestic speculative capital means that local market sentiment and fund flows can now rapidly amplify and impact global prices. This is a fundamental evolution in how the metals markets work, and the With John AG team believes silver is the next target of this Chinese retail capital wave. Think about what happened to silver in January when it hit $121.60. That move was driven by Western retail buying. Now imagine what happens when the Chinese retail capital that has already pushed base metals to record levels discovers the silver story, the structural deficit, the solar demand, the monetary metal properties. The With John AG forensic analysis of Chinese retail trading patterns shows that when this capital identifies an opportunity, it moves with a speed and scale that overwhelms the existing market structure. The global silver market trades approximately 1 billion ounces per year. If even a small fraction of the Chinese speculative capital that has been flowing into base metals redirects to silver, the price impact would be extraordinary. The With John AG forensic team is monitoring the SHFE silver contract volumes daily, and we are seeing the early indicators of exactly this rotation beginning. But the Chinese dynamic cuts both ways, and the With John AG forensic analysis would not be complete without addressing the volatility implications. ING's Manthe noted that while fundamentals still matter, the growing influence of speculative positioning points to more severe and frequent volatility and a heightened risk of abrupt market reversals. Chinese regulators have intervened repeatedly to cool speculation. The SHFE and Guangzhou exchanges have issued over 38 circulars this year aimed at curbing excessive speculation in commodities. They have raised margin requirements and widened daily trading limits for metals like platinum, lithium, nickel, and tin. The With John AG forensic view is that these regulatory interventions will create sharper pullbacks in silver, but they will not change the structural direction. Every pullback caused by Chinese regulatory intervention is a buying opportunity because the underlying deficit is physical and cannot be regulated away. You can raise margin requirements on a futures exchange, but you cannot create physical silver that does not exist. Ole Hansen, head of commodity strategy at Saxo Bank, pointed out that the upcoming Lunar New Year holiday in China may lead traders to reduce exposure beforehand, potentially weighing on short-term prices. The With John AG forensic team views this seasonal pattern as another tactical entry point for investors who understand the bigger picture. The Lunar New Year pullback in metals prices has been a consistent pattern, and savvy investors have used it to accumulate positions before the post-holiday demand surge. Silver in particular tends to see strong performance in the weeks following the Lunar New Year, as Chinese industrial demand resumes and speculative capital returns to the market. The volatility in silver compared to gold is something that the With John AG forensic team wants to address directly because it is both the greatest risk and the greatest opportunity in the precious metals space. Greg Shearer, head of base and precious metals strategy at JP Morgan, discussed this exact topic in a recent analysis breaking down why silver's price is so volatile compared with gold. The answer lies in silver's dual nature. Gold is primarily a monetary and investment metal. Its demand is relatively stable and predictable. Silver, on the other hand, is split between industrial uses and investment demand. This means silver is subject to both the forces that drive gold prices and the forces that drive industrial commodity prices. When both sets of forces are aligned in the same direction, as they are right now, silver moves with a velocity that shocks most investors. The 147% gain in 2025 is a perfect example. Gold had an excellent year, but silver dramatically outperformed because it was being lifted by both monetary demand and industrial demand simultaneously. The With John AG forensic analysis of the gold-to-silver ratio shows that despite silver's massive run in 2025, the ratio is still suggesting that silver has significant room to outperform gold. In historical precious metals bull markets, the gold-to-silver ratio has compressed to levels far below where it sits today. During the 1980 peak, the ratio fell to 15-1. During the 2011 peak, it fell to 30-1. With gold currently at 5,000 and silver at 81, the ratio is approximately 62-1. If the ratio were to compress to even 40-1, which is still well above the historical extremes, silver would be trading at $125 an ounce. If it compressed to 30 to 1, silver would be at $167. And if we see a compression anywhere near the 1980 extreme of 15 to 1, we are looking at silver above $300 an ounce. The With-John AG forensic model assigns the highest probability to a ratio compression toward 35 to 40 over the course of this bull cycle, which implies a silver price between $125 and $143. From current levels around $81, that represents 50 to 75% upside just from the ratio compression alone, before accounting for the continued rise in gold prices. The jewelry and silverware demand data from the Silver Institute reveals an important dynamic that the With-John AG forensic team has been tracking. Jewelry demand is projected to fall for the second consecutive year, declining by 9% to 178 million ounces. This is the lowest level since 2020. Silverware demand is seen falling by 17%, led by India. The mainstream interpretation is that this is bearish for silver. But the With-John AG forensic analysis shows something much more nuanced. Jewelry and silverware demand is falling because silver prices are too high for traditional buyers in India and other price-sensitive markets. This demand is not disappearing. It is being priced out temporarily. When these markets adjust to the new price reality, as they always do, this demand will return, and it will return at a time when the supply deficit is already acute. More importantly, the decline in jewelry and silverware demand is being more than offset by the 20% surge in physical investment demand. The composition of silver demand is shifting from discretionary consumption to strategic investment. This is a fundamental upgrade in the quality of demand because investment demand is sticky, meaning investors who buy physical silver tend to hold it for years or decades rather than consuming it in manufactured products. This means every ounce that shifts from jewelry demand to investment demand is effectively removed from the market for a much longer period. The structural deficit deepens even further. The policy uncertainty surrounding tariffs is another factor that the With-John AG forensic team has identified as a significant catalyst for silver prices. Trade tensions and tariff uncertainty create exactly the kind of economic environment where precious metals thrive. Tariffs are inflationary because they raise the cost of imported goods. They are also contractionary because they reduce trade volumes and economic efficiency. This combination of higher inflation and slower growth is the stagflationary cocktail that has historically produced the largest gains in precious metals. The With-John AG analysis of previous periods of trade conflict shows that silver consistently outperforms during tariff escalation phases because it benefits from both the monetary safe haven bid and the supply chain disruption premium that affects industrial metals. The evolving role of silver in industrial applications is the long-term structural story that the With-John AG forensic research team believes will define this decade. Beyond solar panels, silver is critical in electric vehicles, 5G infrastructure, medical devices, water purification, and emerging applications in artificial intelligence hardware. The electrification megatrend is not a short-term cycle. It is a multi-decade transformation of the global energy and transportation infrastructure. Silver's unique properties, its unmatched electrical conductivity, thermal conductivity, and reflectivity make it irreplaceable in many of these applications. The With-John AG forensic audit of alternative materials research shows that despite billions of dollars spent on finding substitutes for silver in various industrial applications, no viable replacement has been found for most high-performance uses. You can thrift the amount of silver used, but you cannot eliminate it entirely without sacrificing performance. This irreplaceability is the moat that protects silver's industrial demand even at much higher prices. The With-John AG forensic team needs to address the elephant that just entered the room, the record high of $121.60 that silver hit on January 29th. Many investors are looking at that number and thinking they missed the move. They are thinking silver has already had its run and it is too late to buy. The With-John AG forensic analysis of every major precious metals bull market in history shows that this mentality is the single biggest mistake investors make. In the 1970 to 1980 bull market, silver rose from $1.50 to $50. Along the way, there were multiple corrections of 20 to 30% that convinced people the bull market was over. Every single one of those corrections was a buying opportunity. In the 2000 to 2011 bull market, silver rose from $4 to $50. Again, there were gut-wrenching corrections of 30 to 40% that shook out weak hands. Every single one was a buying opportunity. The current bull market began with silver under $20 in 2020. It has risen to over $120. The corrections along the way, including the pullback from 121 to 81 that we are currently in, look frightening in isolation. But the With John AG forensic analysis shows that this correction is perfectly normal within the context of a secular bull market. It is a consolidation that is building the base for the next leg higher. The With John AG forensic team has seen this pattern so many times that we can tell you with high conviction. This pullback is a gift. It is the market giving you a second chance to position yourself before the next surge. The frenzied retail buying that drove silver to its January high is a phenomenon that deserves deeper forensic analysis because it reveals something profound about the state of the global monetary system. When retail investors around the world simultaneously decide to buy physical silver, it is not random. It is a collective recognition that something is fundamentally wrong with the paper money system. People are looking at their governments printing trillions of dollars, running deficits that would have been unthinkable a decade ago, and manipulating interest rates to fund their spending. And they are concluding independently that the only way to protect their purchasing power is to own something real, something physical, something that has been money for 5,000 years. The With John AG forensic analysis of retail precious metals buying patterns shows that this awakening happens in waves. The first wave is the early adopters, the gold bugs and the silver stackers who have been accumulating for years. The second wave is the informed investors who start paying attention when prices begin to rise. The third wave is the mass market, when your neighbor, your coworker, and your family members start asking you about gold and silver. The With John AG assessment is that we are currently in the transition from the second wave to the third wave. When the third wave hits, the demand for physical silver will overwhelm the available supply, and the price will go to levels that seem impossible from today's vantage point. The institutional money is also starting to move, and this is the force that has the With John AG forensic team most excited. Hedge funds, family offices, sovereign wealth funds, and pension funds that have been underweight commodities for years are beginning to allocate. The metals mania fueled by Chinese retail capital has forced institutional risk managers to pay attention. When commodities start outperforming equities by the kind of margins we saw in 2025, the performance pressure forces institutions to add exposure or risk falling behind their benchmarks. The With John AG forensic analysis of CFTC positioning data shows that managed money net long positions in silver are elevated but not at extreme levels. This means there is significant room for institutional buying before positions reach the kind of crowded levels that typically precede major corrections. The institutional bid for silver has room to run, and when institutions buy, they buy in size. A single large hedge fund allocation to silver can consume weeks of mine production. Multiple institutions allocating simultaneously can create a demand surge that fundamentally reprices the metal. The With John AG forensic team wants to connect the silver market dynamics to the broader macroeconomic picture, because understanding the context is essential for having the conviction to hold through the volatility. We are living through a period of unprecedented fiscal and monetary experimentation. Governments around the world have accumulated debts that can never be repaid in real terms. The only question is whether these debts are defaulted on explicitly or inflated away through currency debasement. History shows that governments always choose inflation because it is politically easier. Inflation transfers wealth from savers to debtors, and the biggest debtor of all is the government itself. This is why precious metals outperform during periods of fiscal excess. They are the only financial assets that cannot be inflated away. The With John AG forensic analysis of the current fiscal trajectory shows that the conditions for sustained currency debasement are firmly in place. The U.S. is running annual deficits of $2 trillion with no realistic plan to balance the budget. Other major economies are in similar or worse fiscal positions. This creates a structural tailwind for gold and silver that will persist for years regardless of short-term price fluctuations. The landscape of global metals pricing power is being redrawn, according to the institutional analysts the With John AG forensic team follows. China is emerging as the most critical and dynamic variable in the new equation. Macro trends and speculative positioning are expected to remain the dominant market drivers in the near term, but the With John AG forensic view extends beyond the near term. Over the medium to long term, the physical supply deficit in silver will reassert itself as the dominant force. Speculative positioning can move prices in both directions in the short term, but it cannot create physical silver that does not exist. When the paper market and the physical market diverge too far, the physical market always wins. And right now, the physical market is telling you that silver is scarce, getting scarcer, and priced too low relative to its true scarcity value. The With John AG forensic team has been running probability scenarios for silver prices over the remainder of 2026, and our base case, which we assign a 50% probability, sees silver trading between $100 and $120 by year-end. Our bull case, which we assign a 30% probability, sees silver retesting and exceeding the January high of $121, and potentially reaching $150, driven by a combination of continued physical deficit, strong investment demand, and a weaker dollar. Our extreme bull case, which we assign a 10% probability, sees a supply crisis or geopolitical event driving silver above $200 in a blow-off move similar to what we saw in silver in 1980 and more recently in palladium and rhodium. Our bear case, which we assign only a 10% probability, sees silver pulling back to the $60 to $70 range on a global recession that temporarily destroys industrial demand. Even in our bear case, we view silver as a buy, because the structural deficit means that any demand destruction is temporary, while the supply constraints are permanent. The With John AG forensic conclusion is clear and unambiguous. Silver is in a structural bull market driven by forces that are beyond the control of any government, central bank, or regulatory body. The supply deficit is physical and real. The demand drivers are multiple and reinforcing. The monetary backdrop of fiscal excess and currency debasement is the most favorable for precious metals in 50 years. The Chinese retail capital wave is adding a new dimension of speculative demand that the market has never experienced before. And the institutional allocation to commodities is in its early stages with significant room to grow. The With John AG channel exists to bring you the forensic truth about these markets. While the mainstream financial media focuses on daily noise and clickbait headlines, we are here to provide the deep structural analysis that allows you to make informed decisions about your financial future. Silver at $81 an ounce in the context of a 6-year structural deficit and a 147% gain last year is not expensive. It is cheap. It is cheap relative to where the fundamentals say it should be. It is cheap relative to where the supply deficit will force it to go, and it is cheap relative to the purchasing power destruction that is being engineered by governments and central banks around the world. The window of opportunity is open, but it will not stay open forever. As physical investment demand surges 20% this year, the available supply of investment-grade silver is being absorbed at an accelerating rate. When the retail mints and refiners start reporting delivery delays, and the With John AG forensic team is already seeing early signs of this, it signals that the physical market is tightening to the point where price is the only mechanism left to balance supply and demand, and price must go much higher to do that job. Make sure you are subscribed to the With John AG channel right now. Hit the notification bell so you do not miss a single update as this historic bull market unfolds. Share this video with every person you know who cares about preserving and growing their wealth, because the information in this forensic analysis could be the most valuable thing they encounter this year. The silver deficit crisis is real. The supply is constrained, the demand is surging, the Chinese capital wave is building, the institutional allocation is beginning, and the With John AG forensic research team will be here every step of the way to guide you through the biggest opportunity in the precious metals market in 50 years. The 6-year deficit is a ticking time bomb that the market can no longer ignore. The With John AG forensic analysis is complete. The data has spoken. Silver is the trade of 2026. The structural forces are aligned. The technical patterns are bullish. The institutional research confirms the thesis. And the physical market is tighter than at any point in modern history. This is not speculation. This is forensic fact. The silver supercycle is here, and it is just getting started. Thank you for watching. Subscribe now to the With John AG channel, and I will see you in the next video, where we break down exactly how to position your portfolio for the silver explosion that is coming. The deficit cannot lie. The supply cannot grow fast enough, and the demand is relentless. The With John AG forensic verdict is in. Silver is going much, much higher. Do not miss this move. I will see you in the next one.